Some traders, they are just legends, right? Their instincts seem almost supernatural. But what if I told you their success isn't magic? What if it's a set of hard-won rules that, well, any of us can learn? Today, we're going to dive into the playbook of one of the greatest traders of all time. And it all ticks off with a strategy that is so simple, it almost sounds unbelievable. I mean, just imagine this. A single line on a chart that could have turned 100 grand into $5 million, all from following just one simple rule. So, what is this strategy? It's basically this. When the price of something, a stock, whatever, when it crosses above its 200-day average price, you buy. And when it crosses below, you sell. That's it. Seriously, it's so simple that most of the, sophisticated traders out there just laugh it off. Yeah, but they really shouldn't laugh because a legendary billionaire, a guy named Paul Tudor Jones, used this exact signal as the foundation for his entire trading empire. But, and this is the important part, as you're about to see, that chart, that's just the tip of the iceberg. The real secret is the whole system of thought he built around it. All right, so let's get into this foundational signal. What is it, really? Well, it's all about figuring out the big long-term trend. Are we in a bull market or are we in a bear market? This simple little tool gives him his very first clue. Okay, so the 200-day moving average, it sounds technical, but it's not. It's just the average closing price of an asset over the last 200 trading days. Think of it like this. It smooths out all the crazy daily ups and downs, all that noise, and gives you a really clear picture of the market's real underlying momentum. For Paul Tudor Jones, this is his baseline for reality. It's the first filter for every single decision he makes. Now here's where the story gets really interesting. Jones didn't just pop up as some perfect trading genius. No, he was forged in the fire of an absolutely epic failure. I'm talking about an experience that almost ended his career before it even got off the ground. So let's look at the timeline, because this is where you see how it all connects. Back in '79, he's trading cotton, he gets cocky, and he loses almost 70% of his capital. Wiped out. He was absolutely devastated. But that incredibly painful lesson, it became his superpower. He starts his own firm in 1980, and by 1987, armed with this brand new deep respect for risk, he famously predicts the Black Monday crash. And from there, his career has just been this incredible masterclass in betting against the crowd, and also in philanthropy. And that right there, that disaster in the cotton market brings us to the absolute core of his entire philosophy. Rule number one. And it's not about making money. It's about not losing it. He lives by this rigid four-step defensive checklist. Okay, step one, he assumes every single trade he makes is wrong from the get-go. Wild, right? But that mindset keeps him on his toes. Step two, he knows his exit point before he even enters the trade. No exceptions. Step three, he never risks more than 1 to 2% of his total capital on a single idea. And finally, step four, he only pulls the trigger on a trade if the potential reward is at least 5 times bigger than what he stands to lose. I mean, he says it himself. The most important rule is to play great defense, not great offense. See, for him, trading isn't about trying to hit home runs all the time. It's about making sure you never, ever strike out. Protecting your capital, that's everything. Okay, so once his defense is locked in tight, then he starts thinking about offense. And honestly, this is where his genius really shines through. He has this incredible ability to combine the huge, big picture global economic view, what traders call the macro, with the nitty-gritty signals right there on the price chart, the technical. And there is no better example of this in action than his most legendary trade, calling the 1987 Black Monday crash. We're talking about a day the market just fell off of a cliff, down over 20%. This case just illustrates his method perfectly. So on the macro side, the big picture, he saw this terrifying parallel between the soaring 1980s market and the crazy speculation just before the 1929 crash. Then on the technical side, he's looking at the S&P 500 chart, and he sees it breaking through key support levels. So the big story and the tiny chart details were screaming the same thing at him. Get out and bet on a collapse. But wait, he didn't even stop there. This is what's so brilliant. He was already thinking 2 moves ahead, like a chess grandmaster. He knew a crash of that size would create mass panic, and that would force the Federal Reserve to slash interest rates to save the economy. So while everyone else was frantically selling stocks, what was he doing? He was buying bonds because he knew they would skyrocket in value as interest rates fell. So he made a killing on the crash and then made another killing on the reaction to the crash. Just incredible. Which brings us to his final rule. And this might be the most difficult one of all. Because Paul Tudor Jones believes that after all the charts and all the analysis is done, trading is ultimately a game of psychology. It's about bravado and, most importantly, emotional control. Let's look at his massive bet against the Japanese stock market bubble in 1990. It is a perfect case study in what is basically psychological warfare. See, everyone knew Japan was in a massive bubble. They even called it the foam. But nobody, and I mean nobody, had any idea when it was going to pop. So what was his signal to act? The market dropped just 4% in January. That's it. And Jones pounced. Why? Because he had this unique psychological insight. He knew that Japanese fund managers were culturally, almost religiously, driven to hit an 8% annual return. So he made a prediction that even a tiny loss so early in the year would trigger their deepest fear. It would cause them to panic sell stocks and pile into safe bonds just to protect that 8% target. He was literally betting on their fear. And he was absolutely right. The market completely collapsed. But here's the twist. This psychological strength isn't about arrogance at all. It's the opposite. It's built on a foundation of just radical humility. He's constantly warning against ego. He says things like, and he puts it even more bluntly than that. He says, the second you think you're very good, you are dead. You see, for Jones, self-doubt isn't a weakness. It's his most important survival tool. Okay, so let's wrap this all up. What is the ultimate takeaway from the Paul Tudor Jones playbook? It really boils down to a three-part system. First, master your risk, play great defense, use strict loss limits, and demand a high reward for the risk you take. Second, connect the dots. You have to combine the big economic story with what's actually happening on the charts. And third, win the mind game. You've got to control your emotions, get rid of your ego, and be willing to bet against the hysteria of the crowd. So remember that simple 200-day moving average we started this whole thing with? Turns out that was never the real secret. It's just a tool. The real secret, the magic, if you will, is the disciplined, battle-tested system of thinking that he built all around it. At the end of the day, Paul Tudor Jones proves that the markets aren't just about numbers on a screen. They're about human behavior, raw fear, and unchecked greed. He treats it all like the ultimate game of high-stakes psychology. So, knowing that, what's your next move?